Today on the Joseph Carlson Show, we're going to be looking at my portfolio and one of my biggest holdings, which is Disney. My current position size is $21,600. And even during a red market, Disney's in the green by 4.8% today because they beat their earnings expectations by a lot, across the board, both in their parks and in their streaming. So we're going to dive into the Disney earning report. I'll show you my thoughts on it. We'll dive into the streaming numbers, the park numbers, the future expectations for this business. And we're also going to look at an interview with Bob Chapek that he just did yesterday on the future of this company. Now, outside of Disney, we also have some big news to get to. The US inflation rate came out today, and it was at 7.5% from this year to January of last year. So I'll also be jumping into this inflation report and breaking down the numbers in this episode. So we have a lot to jump into in this episode. As always, if you want to follow along with the progress of this portfolio, this is real money, $358,000 invested, 66,700 of that being gains currently. And I'll be showing the progress of this portfolio every single week, week by week. So no matter what happens, you'll be able to see how this turns out. Another thing I want to mention is if you haven't tried out the Patreon, you should give it a try. It gives you access, no additional charge for Qualtrim Insights. So you get access to the software, you can plug in any ticker symbol, and see all the fundamentals of a company, the revenue growth, EBITDA, free cash flow, net income, debt, dividends, cash, earnings per share, the shares outstanding, whether they're diluting you or doing share buybacks. You can see all this information already calculated and displayed on a single page, which makes the research on companies a lot easier. You get the entire picture on one page. So if you want to try this out with a free trial, there's a link in the description of this video. A lot of people are enjoying using this. We now have over 2,000 users of this software and a lot of future things planned with it. We're constantly building out new features for it. Now let's go ahead and jump right in. Like I said, this is my portfolio, the passive income account. My focus on investing is high quality companies that are attractively valued, that I think have a long runway of growth and a good wide moat. Most of the companies that I invest in pay a dividend. And when I originally invested in Disney, it also paid a dividend at that time. This is what it looks like on Qualtrim Insights. You can see the dividend history of the company. Disney has been, for a very long time, all the way since before 2000, a dividend-paying company. It was never a big dividend payer. It's never a high-yielding company, but it was a dividend payer. But then you can see the dividend stopped in 2019. That was the last time that they paid a dividend, and they haven't issued one since. So Disney's one of the few companies in my portfolio, maybe the only one, that doesn't actively pay a dividend. And I give this one a little bit of a pass. They had to stop their entire operations of their company, close their parks, they halted their dividend, they transitioned to streaming. They did a lot of things for the future that I think were wise, and I thought this is actually a good allocation of their capital. And I don't suspect that Disney will be paying a dividend anytime in the near future. My expectations for them paying a dividend in the future is probably around 3 to 5 years, once they really see the whole streaming business grow to size. But right now, Disney's focused on something other than the dividend. They see a lot of new growth opportunities, specifically with streaming, and they are growing. Let's go ahead and just look at some of the surface level numbers here. This is what everyone looks at. The EPS, the earnings per share, came in at $1.06 versus 63 cents expected. That is a massive beat on EPS. And this is something that Disney's struggling to get back up to where it was previously. If we go to Qualtrim Insights and bring up the earnings per share here, you can see where it is right now, 80 cents, 60 cents. This is where it was before the pandemic. $1.87, $1.48, $1.84. Their earnings are close to $2. So we know this company has the potential to earn a fortune. And they're not doing that right now because largely they've transitioned to reinvestment mode. And a huge part of that reinvestment is Disney Plus. Their subscriber gains were phenomenal. They gained 12 million net addition subscribers, ending at 129.8 million versus 125.7 million expected. And then in addition to the subscriber gains and the earnings per share, they also beat on the revenue, 21.82 billion versus 20.91 billion. So the quick surface level summary here with Disney earnings is they beat on subscriber gains, they beat on revenue, and they beat on earnings. And they beat all three of them by a lot, especially the subscriber gain and the earnings. Probably the two most important. Now we could just look at these metrics and say they beat their earnings, their revenue, their subscriber gains, so everything is going well. But you can dive into this a little bit deeper. This actually doesn't paint a very clear picture of what's going on with Disney. For instance, in the earnings report, it says the subscriber number includes nearly 12 million Disney Plus subscriptions added in the first quarter. So that's kind of the headline news. They gained 12 million new subscribers. Well, that doesn't really paint a full picture, because not every subscriber is equal. For instance, we can look at Netflix versus Disney with their subscriber numbers. This is a chart created by Alex Morris on the Science of Hitting on Twitter. You can look him up if you want to see more charts like this. But what he did is he overlaid the total subscribers by quarter of Netflix and then Disney Plus. And he put them together so you can see the rapid pace at which Disney Plus is growing. It's actually closing the gap between their subscriber count and Netflix's. It could eventually pass Netflix over time if it continues growing at this same rate. So that's good that Disney Plus is growing really fast, especially compared to Netflix, which is the king of streaming right now. But we also have some good news because the growth reaccelerated. You can see that from Q3 to Q4, this is the financial quarter, so this is actually mid-year, but the growth actually decelerated a lot. It only went from 116 million to 118 million. The slowdown in growth the 2 quarters before was not encouraging to investors. In fact, I remember after these 2 quarters, with only a couple million in growth, the news media was very quick with their short-term focus to say that streaming growth is over, streaming companies can't really grow, growth is decelerating. That was the news. Here's an article from November 10th from CNBC. Disney makes the trend clear. Growth is slowing for streaming services. This is the news media. You can't pay attention to this. They live by the quarter. Everything is quarter by quarter. They don't have any long-term outlook. After having this ridiculous headline that growth is slowing for streaming services because they had one slow quarter, Disney went on to gain 12 million new subscribers the very next quarter. 12 million new subscribers, and Netflix went on to gain 8.3 million. Both of them had explosive growth the very next quarter. The important thing with Disney and any company is having a long-term perspective. Now, one thing I want to mention with this chart, although it's really interesting to look at, it shows the rapid growth of Disney compared to Netflix, I do want to dive in a little bit deeper because I don't think this is actually a very fair comparison. If you're an investor in Disney, you should know the breakdown of the Disney Plus service. It's broken into 2 categories, Disney Plus and then Disney Plus Hotstar. Hotstar is a different version of Disney Plus. It operates a little bit more like cable or like Hulu, where it has sports and different stuff on it that the normal Disney Plus service doesn't have. In the US, we have Disney Plus. In countries like India, they have Disney Plus Hotstar, and through parts of East Asia. Now, that's not the biggest difference. The biggest difference is the average revenue per user. They are widely different between the 2 services. For instance, we can look at this breakdown of the average monthly revenue per paid subscriber. This is really important. In domestic, which is the US and Canada, this is Disney Plus, not the Hotstar service. It's $6.68. That is the highest tier of Disney Plus. $6.68. Internationally, excluding Hotstar, it's $5.96, a little bit cheaper. Then Disney Plus overall, with those 2 meshed together, excluding Hotstar, is $6.33. But then we introduced the Hotstar service. This is a huge part of the subscriber base. This is all the subscribers in India. Millions and millions of new subscribers are from the Hotstar service. This is $1 per user per month. So this brings down the overall average revenue per user per month to $4.41. So even though this chart shows Disney closing the gap and catching up to Netflix, one thing that you might want to keep in mind is that Netflix's average revenue per user all across their subscriber base is around $11, while Disney Plus's average revenue per user is at $4.41. So we actually look at a holistic comparison and give more nuance and context to this. The Netflix subscribers are much more valuable. They're over double the value of a Disney Plus subscriber, meaning that on a total value, the Netflix subscriber base is probably 4 times as valuable as Disney Plus. Now that may change in the future. Disney Plus can raise their prices, they can raise their ARPU, which they have been doing. They say that the service also saw an average revenue per user, ARPU, in the US and Canada grow to $6.68 per month from $5.80 a year ago. So they are growing their ARPU, but they're still a long ways away from catching Netflix with their ARPU. Netflix is sitting at $11 across their entire subscriber base, not just the US and Canada, and Disney with their entire subscriber base is sitting at $4.41. So I'm not trying to throw cold water on this. This is a fantastic report. Disney's moving in the right direction, but I think it's important for investors to realize the differences in subscriber value. Now, having said that, let's go ahead and jump into this interview with Bob Chapek, the CEO of Disney. He answers a couple really good questions. One of them is if he has changed his subscriber goal for 2024. Disney wants to get to over 230 million subscribers for Disney Plus in 2024.
We're reaffirming our guidance of 230 to 260 as we gave last December. That's been our target. That continues to be our target. And really what's driving is what we've said, great content. We'll have more franchise added content on our big franchises added this fiscal year, double what we had in 21. So that new content really is what drives it. Quarter to quarter, because of the pandemic, we have a little gaps here and there in terms of the content. And so it's not a straight line growth every quarter, but we're reaffirming that 230, 260. We feel very good about that.
So he says that we're reaffirming the 230 to 260 million subscribers by 2024, and that he feels really good about it. This is obviously a good sign. He's not really wavering from their initial goal. And I also think the other things he said are accurate as well. Disney does have these core franchises they can continue to pull from. He says we're putting double the amount of original franchise content on Disney Plus this year than we did last year. This increase in original content on Disney Plus is something that consumers and investors are both asking for. Consumers want it. They want to get more value out of Disney Plus. There's not a ton of content on it. And investors want the same thing. They want consumers to be addicted to this service so they can continue to grow their subscriber base. So Bob Chapek is doing both what investors want and consumers want by putting more content on Disney Plus. This will put temporary pressure on the earnings of the company, the bottom line of the company, and their operating income. They know the economics of streaming and the huge opportunity here, and I'm glad that they're trying to take advantage of it. Now, the next thing that he's asked about is the release of Encanto and how it was released very quickly after going to theaters. Is this going to be a continued thing, where you have shortened releases in the theaters before it goes to streaming? Before I play his answer, I just want to mention one key statistic here that he doesn't mention. They found out that around 90%, 90 to 95% of the box office revenue is made within the first 45 days. So there's no reason to keep exclusive box office windows for 90 days when you're making 90 to 95% of the revenue from the box office within the first 45 days. So I think what Disney's doing is just monetizing this as smart and intelligently as possible. They're keeping their big blockbuster movies in the box office for 45 days, getting the 95% of that potential revenue, and then releasing it on streaming. But here's the answer he gives.
Well, we've always said we're going to have a flexible distribution strategy right now, and the reason is because we're in a world of flux. Changing consumer behavior because of the availability of titles in homes. Our consumers have had a chance, our viewers have had a chance to enjoy that. They love it. And at the same time, a lagged recovery, if you will, from COVID in theaters. And so we'd like to remain as flexible as possible, but we do believe in the future of the theatrical business, particularly for our big tentpole titles. Obviously, there are certain demographics that are slow coming back. The family films, that's one thing that's been a little bit slower. And the films that sort of go outside the big blockbusters, those are slower to come back. But we believe that we've got a lot of options between our theatrical exhibition releases, as you saw with Encanto, with a short window, or direct to our service, as you're seeing with Turning Red coming up in March. We're really, really excited about the options that we can give to our audience.
This puts Disney in such a good situation. If you think about this compared to other companies, it's like Disney has become vertically integrated. They control almost everything from their content creation to now their distribution. No longer do they have to go through any gatekeepers with the movie theaters. They can use them to maximize revenue, but they also have flexibility. They have their own outlet for content distribution with its own economic model that in many ways is superior. So Disney can bounce back between using the box office whenever it has the most economic value, and using streaming whenever that's a better alternative. They hold all the power and flexibility with their distribution. Now, he's also asked about sports and if they're going to buy the NFL Sunday ticket. Here's his answer.
Well, we're bidding for it, and we always say that if an investment is accretive to our shareholders, we'll go ahead and do it, but the moment that it's not, we'll back out, and we hope it is.
So they're bidding for it. Who knows if they're going to get it? You have some other relatively large companies bidding for it that have a little bit of discretionary cash, like Amazon, for example. So Disney does have huge competition bidding for this, but I think there's a good chance they might get it. Now, this next question I think is a bit more of a hardball for Bob Chapek. It is about raising prices for the Disney parks and how that's making Disney receive a lot of backlash online.
The lowest price days have stayed the same, but the truth is that the more crowded times, the more popular times, those prices have gone up. There's been backlash online. People want to be able to afford to take their families. How do you address those concerns, and what is driving those prices up? Is it inflation? Is it labor shortages?
Demand.
She's asking what's causing the rising prices at Disney Park, and he answers demand. Simply put, they price things based off of demand. So you really don't have to be an economist to figure this out. There's a lot of demand for Disney parks and only so many Disney parks, so they're raising prices as a result. This is what almost any company does when they have a lot of demand for their product. And in an inflationary environment, like we're finding ourselves in now, you want companies that have pricing power, companies that can increase prices as cost of goods and services and employees go up. So overall, Disney's a company that has struggled over the past year. It had its huge downturn, its big recovery, and then another downturn over the past year. And now it's basically flat from now to 2019. This company has struggled a lot more than other ones in my portfolio, but I continue to hold it because directionally, everything with the company is moving in a positive direction. All the streaming subscribers are growing across the board, earnings are growing, operating income's growing. The parks have largely returned back to their 2019 prior to COVID levels, and I only see that growing over time. I think the parks will continue to be massive moneymakers for this company. So Disney has a long ways to go. This company, in my opinion, is a long-term growth story. Their assets and content library, I think, will carry them for at least the next 10 years. Now, moving on from Disney to a much less magical topic, let's go ahead and jump into inflation. The inflation report was bad. It was a bad report. It was 7.5% annually over January of last year. Now, they actually break down what is causing this inflation. And this is what I think is interesting, is the way that they weight the inflation. They say used car prices continue to drive overall inflation, rising 40.5% in January from a year ago. But used cars, of course, weren't the only thing. They also mention a sharp uptick in housing and rental prices also contributed to last month's increase. Food prices surged 7%, the sharpest rise since 1981. Restaurant prices rose by the most since early 1980s. Pushed up by an 8% jump in fast food prices from a year earlier. Grocery prices increased by 7.4% as meat and egg prices continue to climb at double-digit rates. You can look at this with some context here. Here's a graph showing what's really contributing to inflation. You can see that the huge ones are used cars and trucks. 40% inflation from a year ago. That is incredible. Then there's gasoline, which the prices of gas and energy are up like crazy, and electricity's up quite a bit as well. And then the other items that were measured were actually below the average. So food, and then fast food, apparel, shelter, all of those are below the average. The big things driving up inflation overall is the used cars, transportation, energy, electricity. Now I know the drill. When you see big inflation reports like this, the go-to person to blame is the Fed chair, Jerome Powell. Everyone points their finger at him and says he's the one to blame. He needs to raise interest rates and he needs to do it quickly. I assume that they're going to do a number of interest rate hikes to try to suppress some of this demand. I think we have too much demand for products and there's not enough supply to keep up with it. These imbalances between supply and demand are way out of whack right now, but I do think they'll eventually be resolved over time. With a normalized interest rate environment, with more logistics coming back on track, I see these imbalances fading. I don't think we're going to see an environment where cars go up 40% year over year forever. That seems entirely unsustainable, so I don't see that happening for too long. But meanwhile, in your portfolio, I think the biggest thing you can do to try to hedge for inflation and interest rates rising are having companies that have pricing power. I think that's the single biggest factor in investing during inflationary environments. I focus on companies like Apple and Microsoft that have pricing power. In consumer, every single company I have has massive pricing power. In real estate, pricing power is more limited. Vici and Simon Property do have pricing power to some extent. They have CPI adjusted rents, they can raise their prices a few percentage year over year, but they can't keep up with 7, 8, or 10% price increases. They simply can't raise it that much. So these type of companies that have less pricing power, like triple net leases, probably will struggle while inflation's running rampant. So I think we'll have to see inflation come down a bit before we see Vici stock really move up. In my restaurant category, I have a new investment in Starbucks, and I bought Texas Roadhouse as well. These are companies that both have pricing power. If inflation goes up 10%, I think both of them can adjust just fine. And then in the banking category, JP Morgan and T. Rowe Price both do just fine during inflationary environments. In fact, if interest rates start to rise, JP Morgan should become more profitable, so that should have a positive effect on them. So with the exception of the real estate category, every single company I hold has an enormous amount of pricing power. They can adjust prices to compensate for inflation. And even within real estate, I tried to focus on a company that has more pricing power than the alternatives. So in aggregate, I think my portfolio is set up really well to deal with an ongoing inflationary environment. Now, if you want to see my entire portfolio and click through every holding, there's a link in the description of this video. Other than that, I'll see you in the next episode.